When you think about the current environment, obviously the Federal Reserve's been increasing interest rates and they've been conducting quantitative tightening, or at least saying that they're going to do it. How do you think about asset prices across the spectrum in relation to that? Should we just see correlations go towards one and all asset prices sell off? Or should we expect to have some sort of decoupling in this type of environment?
That's such a great question. I think it's on everyone's mind right now, as kind of the macro framework and monetary policy kind of dominates the market narrative right now. And from my perspective, one of the things that you learn in kind of like entry-level finance and economics courses is that yields and asset prices have an inverse correlation, all else being equal. And so as we're in an interest rate environment where the Fed is tightening monetary policy and yields on treasuries are moving higher, right? In that environment, we've seen asset prices across the board, whether we're looking at stocks or Bitcoin and crypto, or even treasuries in the bond market, everything is selling off in this environment. And so from my perspective, so long as we remain in this environment, asset prices are going to have headwinds to rise and benefit in this environment, right? So until we really see a formal shift in basically the yield environment, am I expecting to see a bull market?
Yeah. When you start to think about kind of the transition from, let's call the bear market we're in now, pretty much across asset classes, into a bull market, is it just when does the Fed let their foot off the gas pedal, or is there other things that you would be looking for?
I think there's some other things, right? Like the Fed is clearly behind the curve in this environment. And so if we start to see inflation data formally roll over and kind of sustain that rollover, then I think that could be a general foreshadowing of a reversal in the monetary policy environment. But if we look generally speaking at stock market and crypto relative to monetary policy, we can kind of get some clues as to how these assets have behaved in the past relative to monetary policy. And so if we look at when Bitcoin and the stock market bottomed in 2018, it was in December of 2018 when the Fed formally paused their rate hikes. And so we had a formal shift in the monetary policy outlook and environment. When did asset prices bottom in 2020, including crypto, right? Is the Fed came out and formally said, we are here to provide infinite support to the monetary and financial system. And asset prices ripped higher. When did stocks and Bitcoin and crypto broadly peak? In November of 2021, when the Fed announced that they were tapering. So it's a super simple and kind of like crude metric for where asset prices are going to go going forward, but it's been super accurate in this kind of like monetary wonderland that we're in, right?
Yeah. When we start to look at certain parts of the market, there's aspects that I know you've been paying attention to that we just haven't talked about that much on this show. So I'd love to kind of go through this. The first is this idea of loans and leases. And you've identified that it's one, expanding at a rapid pace, but also there's this relationship with inflation. So maybe explain a little bit about this loans and leases and how people should think about this as part of the financial system.
Sure. So I spent 2 years working on the commercial banking side as a portfolio analyst. So I got really familiar with looking at this kind of data overall. And I've been out of that field now for almost 2 years. So nothing I'm about to say is indicative of like my former employer or anything like that, right? But essentially, when I look at loans and leases, I think it's very important because as we think about the inflationary dynamics, obviously the Fed came out and they printed all of this money and operated QE through like crazy, right? For 24 months plus. And obviously the monetary base in M2 expanded during that period, but until we see that money really come into the actual real economy and leave the financial and banking system, I think that's going to bring more inflationary pressures in. So in the upper bound of this chart, we're looking at the nominal value of total loans and leases that have been issued by commercial banks in the United States. And it just hit an all-time high in early June at roughly $11.3 trillion. In the lower bound of this chart, what I've done is I've actually denominated loans and leases and I've divided it by M2 money supply. So this gives us somewhat of an indication of credit creation relative to the monetary base. And if we look over time, basically since 2000, we get these distinct kind of rolling overs at the tops and curling back up during an uptrend. And it appears as though for the past 6 to 7 months, loans and leases relative to the monetary base are starting to increase again. And I think that's one of the main reasons why we've continued to see inflationary pressures in 2022.
So when you see this, basically people are just borrowing what was cheap capital, now becoming more expensive, and they're using other people's money essentially to go ahead and buy assets, to consume, do whatever they're doing from a spending standpoint. And that ultimately influx of kind of like net new capital is driving up asset prices and also consumables and kind of increasing demand. And therefore, until we start to see relief here, then we shouldn't expect inflation to come down materially. And part of the Fed's actions to increase the cost of capital is to drastically reduce the demand for these loans and leases and therefore bring inflation down.
I think that's a fair assessment, Pomp. And this data here, loans and leases, includes consumer loans. It includes loans secured by real estate. It includes commercial and industrial loans. So this is really a full picture of the total credit market, if you will, in terms of the business and consumer demand for new loans.
Got it. And so when we start to see this number come down, how quickly would you expect it to come down? Is it something where, okay, now that everyone realizes the Fed's serious, that a 75 basis point hike, and we should expect to see this data like fall off a cliff? Or is it something that's more gradual and kind of takes time for people to recognize the market is changing, the cost of capital is changing, and therefore I was going to get a loan in September, but actually I'm not going to do that. And so that would take a couple of months before it got kind of quote unquote priced into the market or revealed in this data?
Sure. So one main point on this that I'd like to say is that I expect to see loans and leases continue to expand, even if we go into a recessionary environment, because even in that environment, businesses are going to need capital to operate, right? And so the one thing that I'm really going to be paying attention to is the rate of change in the growth rate of loans and leases. So if we look at the year over year growth in loans and leases, it's about 9%. And what's the inflation rate right now measured by the CPI? It's 8.6%. And there's no rule or law or theory that says that these should grow in line with each other. But I think if we want to see inflation data materially roll over, we're going to need to see a deceleration in the growth rate of loans and leases. I think that's the way that I would put it. And on a year-to-date basis, loans and leases are up almost 4.5%, 5%. So again, we're seeing ample demand from businesses to acquire new debt and expand production, whatever the case is. I'm not sure exactly what they're using the capital for per se. It could be to buy back their own stock or increase their dividend, right? I'm not sure. But even if we look at subsectors of loans and leases and we look at something like commercial and industrial loans, which I really view as something like capital expenditures or growth in the production, something of that nature, that number right now is about $2.6 trillion. And so that's also growing at a pretty solid rate, much slower than overall loans and leases, but still increasing. So that to me just implies that credit creation is on the rise.